In the world of vacation rentals, Vacasa was the elephant. Big, bold, hard to ignore. They raised over $800 million, bought rivals like Wyndham and TurnKey, and went public in 2021 through a flashy SPAC deal worth $4.5 billion. At their peak, they managed 40,000 homes, the biggest name in the US. But early 2025, that dream had cracked. The stock had dropped over 90%. They laid off more than 2,700 employees. The tech, well, was maybe less solid than expected, and the business model starting to fall apart. And then came Casago. Casago is smaller, much smaller. They manage about 5,000 homes across 72 markets using a franchise model. They're based in Scottsdale, Arizona. And their CEO, Steve Schwab, a former Army airborne ranger. No venture capital, no flashy headlines, just steady growth, empowering local operators. In December 2024, Casago made a move no one saw coming. They offered $5.02 per share to buy Vacasa. They valued the company at just $128 billion. Could a company this size really take over the industry giant? It looked like a done deal. But Vacasa is a public company, and with public companies, the shareholders get the final say. That's when the bidding wars began. February 3rd, hedge fund Davidson Kempner, one of Vacasa's creditors, made a 5.25 per share offer. On February 28th, they sweetened the terms. March 14th, late at night, they raised their offer to 5.75. March 17th in the morning, Casago came back, raised their offer to 5.30, and removed all the strings. That same afternoon, Davidson Kempner matched those clean terms. They kept their 5.75 price, added $20 million in funding, and offered penalties if they backed out. Looked like Davidson Kempner had the better offer. But the Casa's board said no. Why? Well, because Davidson Kempner's deal depended on rewriting a complex tax agreement, and the approvals weren't coming fast enough. Casago's offer was clean, fast, ready to go. So Vacasa once again said yes. Well, at least for now, the final decision still rests with the shareholders. A vote is expected in late April. When Casago announced the deal, many in the industry cheered. Here's why. Vacasa was built on centralized operations and hundreds of millions in investor money. Casago grew slowly through local franchises, not Silicon Valley money. People saw the deal as a win for operators, for patience, for a grounded, hands-on approach. Comments poured in. Prove that slow and steady wins. Steve built something real. But not everybody celebrates. Vacasa has laid off thousands of people who had worked hard, people who had a vision, tried something, it didn't work out. And these people cared as well. So while Casago's win was respected, so were the sacrifices of the people who got Vacasa that far. Davidson Kempner may not get to buy Vacasa, but they didn't walk away empty handed. They own 14 million shares. When Casago raised its bid from 502 to 530, that bump alone made them almost $4 million. Davidson Kempner also holds $30 million in convertible debt, which means if Vacasa bounces back, they could turn that debt into stock. So even though they didn't win the deal, they made money, they influenced the outcome, and they walk away with their reputation intact. Now comes the hard part. If shareholders vote yes, Casago gets Vacasa. But buying the company? That's just step one. Vacasa still manages 38,000 homes. That's almost 8 times the size of Casago's operation. The two companies are very different. Casago runs on franchises. Vacasa was fully centralized with everything controlled from the top. Now, Casago has to keep thousands of homeowners happy, avoid service disruptions, merge two completely different cultures, and so try to see how to reuse Vacasa's tech and integrate with their own local model. It's not a merger, it's a transformation. If Casago pulls it off, they will set a new standard for the vacation rental industry.